Hi, Derek.
Hello.
Hey, Derek, what chapter are we supposed to be doing? Not we up to 9 or 10? I'm getting mixed up here.
We're on 11.
Oh, chapter 11. Oh my goodness. Okay, hold on.
Yeah, I think this is this is the last week, or this is the second to last week. We do 11 and 12 this week and then finish next week.
Okay, I didn't remember doing 10. Okay. All right, well, hold on. Let me put my brain back into work here. Chapter 11. So we already went over liabilities, huh?
Yeah.
Okay. Chapter 11. Okay. Give me a moment here. Okay, you see the screen now, chapter 11?
Yes.
Okay, thank you. All right, in the prior chapter, we went through raising money through bonds. Now we're gonna do it through a stock issue. So let's see what we have here. Discuss the major characteristics of a corporation, how to account for treasury stock. Okay. Cash dividends. All right, let's have some fun with this. Major characteristics of a corporation. Corporation is owned by shareholders. The public goes out and buys shares in a company and they become owners of it, okay? You can have for-profit corporations and nonprofit. They can be privately or publicly held, okay? Cargill is a big company and they're pointing out that it's privately held, all right? Characteristics: separate legal existence, limited liability of stockholders, transferable ownership rights, ability to acquire capital, continuous life, corporate management. Let's talk about a couple of these. The limited liability of the stockholders is important. That's called the corporate shield. Unlike a sole proprietor or a partnership where you can lose everything, all your personal assets and possessions in the event of a problem, with a corporation, you were only going to lose whatever you invested in the company and no more than that, okay? Corporation, it's very easy to transfer ownership rights. You just call your stockbroker and he makes the deal immediately, or you do it online. And a corporation is set to have a continuous life. It's a continuing entity. One disadvantage of a corporation: corporation management could be a problem. A lot of government regulations when it comes to a corporation, and corporations pay that additional tax. Corporations have a double tax problem where they pay income tax and tax on dividends. Oh my goodness, look at this organization chart, huh? But this is pretty typical. The stockholders are supposed to be the boss. The stockholders elect the chairman and the board of directors, and then the board of directors choose who the president and CEO is going to be, and then you have your different vice presidents and et cetera, et cetera. The board of directors, they're the ones who decide what kind of dividend is going to be given out and when and how much. Get involved with limited partnerships. I'm not going to talk about limited partnerships or S corps. We have a whole accounting class for that. Barbara Owy's tax class will cover that. We're not going to get into that in this chapter here. You form a corporation, you file with the state, and you're going to get a charter. and you have to follow the bylaws of the state. And you generally incorporate in a state whose laws are favorable to the corporate form of business. Do you know what state is very, very popular, Derek, for corporations to register?
No.
Delaware, of all places. Delaware. A lot of major corporations are incorporated in Delaware, where the restrictions are loose. Could you excuse me for a moment, Derek? I'll be right back. I'm sorry. Sorry about that. Now we're ready to roll. Okay, corporations file with the state, they get a charter, they like to go to Delaware. If you're a common stockholder of a stock, you have the right to vote in all the issues of the corporation. You can vote for the board of directors and other decisions the companies may make, and you may share in the corporate's earnings through dividends. Stockholders have the same percentage ownership when new shares are issued, the preemptive right. So that's the term for where you own shares. You own 14% of the stock of a company, and new shares are issued, you are automatically granted enough stock that you continue to own 14% of the corporation. Stockholders' rights, share in assets upon liquidation. Well, if the company goes out of business, they have what's called a hierarchy in any bankruptcy, and creditors, lenders get paid before stockholders. And stockholders can be split up into preferred stock and common stock. Common stockholders get paid last. And there's an example of a fancy stock certificate. In the old days, you actually got these. Where I worked for a number of years, I always got a bonus. We always got a bonus at the end of the year in the form of shares of stock. It was typically 40, 50 shares of Thomas and Betts stock. And we would actually get the stock certificates handed to us. It was kind of nice, almost ceremonious to be handed that. Nowadays, it's old fashioned. Everything is done online. If you really wanted to get it, I suppose you could. Stock issues. Authorized stock. Charter indicates the number of shares of which stock, the number of shares of stock that a corporation is authorized to sell. We're going to talk about different categories here. We're going to talk about authorized stock, issued stock, and outstanding stock, and treasury stock. Authorized shares. The state will limit the number of shares that you can offer to the public. I don't know how they come up with the decision, but they'll say you can offer 1 million shares of $1 par, say. So authorized shares. The issuance of stock, the issued shares, are the ones that have been sold to the public in the IPO, the initial public offering. The corporation can issue common stock directly to investors or indirectly through an investment banking firm. For our purposes in this course, we're saying we're going directly to investors. So those are issued shares, the ones that have been sold to the public. You have par value and non-par value stock. It's a very unimportant consideration, okay? Par value is a meaningless number. Par value has nothing to do with the value of the stock. Par value can be a penny. It can be $1. It could be whatever the corporation wants to put on their stock certificate. And some stocks don't even have a par value. The only thing we're ever going to do with a par value, Derek, is when we're doing our journal entries and we have to have a line for common stock. We're going to take the shares outstanding multiplied by the par value, and that becomes the line called common stock. Other than that, it has really no meaning other than a legal requirement. Which of these is false? Ownership gives a voting right. Begins with paid in capital. I don't care about that one. Legal capital is intended to protect stockholders. No. Legal capital is to force companies into issuing stock only when they can afford to do so. Indicate whether the following are true or false. We'll go through these. Regarding a corporation, similar to partnership in terms of unlimited liability, we know that's false. It's relatively easy for a corporation to obtain capital through the issuance of stock. Yeah, absolutely. The separation of ownership and management is an advantage of the corporate form of business. Not really. The journal entry to record the authorization of capital stock includes a credit to the appropriate capital stock account. False. I don't even know what they're talking about there. The journal entry to record the authorization. Oh, the authorization, there's no journal entry at all. They're just authorizing the shares. All states require a par value, and we know now that's not the case. Let's take a look at what our equity account now looks like. Paid in capital. This is an important consideration, an important item. Paid in capital. It's the total amount of cash and other assets paid to the corporations by stockholders in exchange for capital stock. You're going to learn it as paid in capital in excess of par. As you see it over to the right here, you have two sources of equity. They're talking about common stock and preferred stock, and we'll discuss them both in some detail here. Common stock, that's the par value. We issued a share of stock with a par value of $1. The market paid us 100 though. So we have $1 in common stock and $99 in paid in capital in excess of par. Same thing with the preferred. We issued a preferred with $10 par value, say, and we got 50 from the public. That would be a $40 paid in capital in excess of par. These are all part of your equity account now. Remember at the beginning of the class, we started with the owner puts $10,000 of his own money in the business. And then we had retained earnings and the profits that would roll through them to increase it, dividends to decrease it. So say hello to common stock and preferred stock and their appropriate paid in capital accounts. Retained earnings has a credit balance, and here they're just showing the closing entry to get rid of it. If Delta Robotics had a balance of 800,000 in common stock and 130 at the end of the year in retained earnings, here's what it would look like. They have common stock, retained earnings in separate sections, okay? They really should have retained, yeah, there's common stock, retained earnings. What I don't see is the paid in capital in excess of par. Comparison of accounts used, reported on the balance sheet. Proprietorship, they all have normal balances of equity being credits, huh? They want to remind us of that fact. Here we go. At the end of its first year, has 750,000 of common stock and net income of 122,000. Well, we have to close out the net income. The net income was 122. So to close it out, we're going to debit the income summary and credit retained earnings. And here's what we end up with. Common stock retained earnings equals the total stockholders' equity. Now we're getting into some more interesting good stuff here. How to account for the issuance of common, preferred, and treasury stock, okay? Identify the sources of the paid-in capital and maintain the distinction between paid-in capital and retained earnings, okay? There are two parts of the equity portion of your balance sheet, and they have specific levels of what goes into each one. Other than consideration received, the issuance of common stock affects only the paid-in capital accounts. So here, we issued stock at a par value. 1,000 shares are issued for $1, okay? And they're $1 par value. Well, that makes it easy. We debit cash and we credit common stock for 1,000. Now pay attention to the next journal entry, Derek. This is the whole point with paid-in capital now. We issued the same shares for $1,000. We issued the same 1,000 shares, but this time we got $5 a share. The common stock number will always be a multiple of the par value. So the common stock is still going to be $1,000, but that extra 4,000 becomes something we're going to call paid-in capital in excess of par. Again, common stock and paid-in capital are both equity accounts. And this is exactly how it would look on your financial statement. You'd have common stock plus paid-in capital, gives you the total. They're calling it total paid-in capital. I'm not sure I like that. And then the retained earnings, $33,000. Issuing stated value. Here we go. No par value stock with a stated value of $1, and the company issues 5,000 shares. Same thing. They issued 5,000 shares at $8 per share. Well, again, we have a slide that makes no sense. If it was issued for $8 a share, it'd be 40,000. I'm skipping this slide. This slide is incorrect and misleading. Issuing no par stock. Well, if you have no par stock, you're not going to have any paid-in capital. So it's as easy as that. They issued 5,000 shares at $8 per share for cash, $40,000. Accounting for preferred stocks. Now, we've just looked at common stock. If you picked up the phone today and called the stockbroker and said, "Hi, I'm Derek. I'm a student at City College. I'm thinking of buying some stock." The stockbroker is not going to ask you, "Are you looking for preferred stock or common stock?" He's going to be 99% sure you want to buy common stock. Preferred stock is a totally different, more conservative, stodgy, if I will, type investment, okay? Preferred stocks are almost like a bond in that it does have a par value on it, which is going to be multiplied as a percentage. So let's take a look at the preferred stockholders. Preferred stockholders have a priority in distribution of earnings, meaning they get a dividend before common. If a company has $10,000 to hand out in dividends, the preferred people get the whole $10,000 and not common stock unless the company has enough money. If the place liquidates, they get paid before common stock people, but they don't have voting rights. Preferred stockholders do not vote, okay? Accounting for preferred stock at issuance is similar to that for common stock. You're going to have the same thing. You're going to have the paid-in capital. They issued 12,000 shares, 10,000 shares of $10 par value for $12. So 10,000 times 10, that's the par value. That becomes your common stock line of 100. And the difference of $2 times 10,000 is 20,000. That's your credit. The cash is $120,000. Cayman begins operations on March 1st. They issued $1 par value, 100,000. Same exact journal entry. You debit cash for the $12 you received from the market, and the common stock line can only be a multiple of the par value. It can only be a multiple of the par value. And the difference is the paid-in capital in excess of par value. Cayman issues 1,500 shares at $10. Well, it's the same thing. 1,500 times 10 is always going to be your stock line, always your stock line. 1,500 times 30, that's 45,000. Your paid-in capital in excess of par is $30,000, okay? Now, we're going to talk about something called treasury stock. So now we're looking at the equity section of your balance sheet. You have your paid-in capitals, you have common stock, less paid-in capital, preferred stock, and retained earnings. Now let's talk about something called treasury stock. Treasury stock are shares that the company has bought back from the public. They've purchased back their own shares of stock. It's a corporation's own stock that has been reacquired from shareholders but not retired. Corporations acquire stock for various reasons: to reissue the shares to officers and employees under bonus plans, to enhance the stock's market value, to have additional shares available for use in the acquisition of other companies, to increase earnings per share. These are good reasons why companies do buy back their own share. But a couple of these reasons are not very good for the public or for the shareholders themselves. If a company is buying back their own shares to enhance the stock's market value, in other words, a company thinks their stock is trading now at 40, and they say there's no way the stock should be trading at 40. We have a good product, a good future. We think the stock is going to go from 40 to 60 in the next few months. Well, if they buy the stock back for that reason, that's good for everybody, okay? But if they buy it back for the first reason, to reissue the shares to officers and employees, that is not such a hot idea in terms of the shareholders go. They're just throwing their money away when they're doing something like that, if they're not prepared to pay the bonuses. When Donald Trump became president, he and the Republicans pushed through a huge tax cut. It saved corporations billions and billions of dollars. And the idea was that billions and billions of dollars would be invested in the economy. They would hire more people. They would open up new buildings, new stores, new factories. Well, almost none of that came to fruition because these companies got that money. To them, it was like Christmas. They took that money and all they did with it was give out shares to their, give out bonuses to their employees. So if the company's buying their shares back just to pay bonuses, that's not necessarily a good thing for the public at large, nor the other shareholders who don't participate in that. Accounting for treasury stock. Use the cost method. You debit treasury stock for the price you pay. Treasury stock is a contra revenue. I'm going to say it again. Treasury stock is a contra equity account, okay? It is an equity account that has a normal debit balance, all right? It's considered to be issued but not outstanding. The number of shares does not change, reduces equity. So let's take a look a little bit here. They're showing you the beginning information that they have common stock of 400,000 shares outstanding at a par value of $5, and 100,000 were outstanding at that time, okay? Now, Meade acquires 4,000 of its own shares. They debit treasury stock and credit cash. Now, keep this in mind, Derek. Treasury stock is not an asset. It is not an asset. A company is not allowed to trade in its own company and call it an asset, nor can you ever record a profit from treasury stock. If you sell those shares back for more money, that's additional paid-in capital. I think you can understand that would be a tremendous conflict of interest if a company could buy its own shares and trade their own shares for profit. The opportunities for fraud are enormous if you allowed that, okay? So treasury stock is a contra equity account. And here's how it would look on the balance sheet. Again, you'd have the common stock at a multiple of the par value. You would have the retained earnings, total 700,000, minus those treasury stocks, whatever you paid for them. Treasury stock may be repurchased for different reasons. We learned a lot of different reasons you could purchase treasury stock. The bad reason, if it's done to reissue shares to officers and employees under a stock plan, or B, to signal to the stock market you think the price is underappreciated. Issuance of stock. Okay. Santa Anita Corp purchases $3,000 of its par value for $180,000. Okay. It expects to hold the shares in the treasury until resold. Okay. Notice we don't do anything with paid in capital or anything like that. So they have 180,000, what they paid for these shares. Debit, treasury stock, credit, cash. Treasury stock, remember, is not an asset. Now, going forward, if they sold this treasury stock, Derek, and they sold it for 200,000, yeah, that's a profit, okay, but you can't call it a profit on your income statement. No, that profit has to be called paid in capital in excess of par, okay? How to account for cash dividends, stock dividends, and stock splits? Okay, let's talk about dividends. Dividends are distributed or a distribution of cash or stock to shareholders on a pro rata basis. And dividends can be in the form of cash, property, equipment, different things, but we're talking cash for the most part here. For a corporation to pay a cash dividend, it's got to have sufficient retained earnings, called legal capital. Payment of cash dividends from retained earnings is legal in all states. You have to have adequate cash and a declaration of dividends by the board of directors. Cash dividend dates. We need to understand these three dates. They all have a significant role in recording a dividend. A cash dividend, the declaration date. Companies do not have to give out dividends. They're not required to. Not even to the preferred holders do they get a dividend. But if a company decides to give out a dividend and they make a declaration of that, that creates the liability. So let's say on August 1st, they announced we're going to give out $1 million worth of dividends. That becomes a liability. You would debit retained earnings and credit dividends payable. The record date is not a transaction date. There's nothing to do accounting wise, but the record date is the date and time where the owners were the owners of the stock. In other words, if the record date was August 15th, whoever owned the stock at the end of business on the 15th gets the dividend. And sometimes you see a little jump in the marketplace around dividend time as people jump in to grab a dividend and then get right out, okay? And then you have, of course, the payment date. Let's say it was August 31st. You write the checks to everybody and you debit, you debit dividends payable and credit the cash, okay? Cash dividend dates. Here, they're recording the dividend. The directors of media declared, as soon as you see the word declared, that means that set up the liability. 50% per share cash dividend on 100,000 shares, that's $50,000. Debit, they're saying debit dividends. It's really debit retained earnings. It's the same thing. Debit retained earnings. The other book, and the way we all learned it, was you debit retained earnings, but that's okay. You debit dividends or retained earnings, credit dividends payable. On the record date, there's no entry, just you figure out who's going to get the dividend. And then on the payment date, you debit dividends payable and credit cash. Question about cash dividends. Entries for cash dividends are required on the declaration record date? No, not on the record date. The answer to this better be D, on the declaration date and payment date. Right, dividend preferences, right to receive dividends before common stockholders. Now we're back in the world of preferred stock. Per share dividend amount is stated as a percentage of the stock's par value or as a specified amount. A par value stock will have a percentage attached to it. They'll have a par value stock that says par value is $100, 6%. That means that stock, if it pays a dividend, and again, the company does not have to pay a dividend, even for preferred, but that dividend would be $6 per share. Preferred stockholders must be paid current year dividends and any other unpaid dividends not received in the past. If it's a cumulative stock, only if it's a cumulative stock. A cumulative preferred stock means just that, a cumulative. You are going to add up all past years and hopefully eventually get caught up to the present day. So in other words, if you didn't get a dividend the last 2 years, and now this year they've got enough to pay off 3 years of dividends, you're going to get that catch up. And that's before the common stock people even get a penny. So here we go. Scientific leasing, excuse me, as 5,000 shares of 7% par value, $100. Each $100 pays $7 a share. The annual dividend is 35. So in a normal year, if they were giving out dividends, these preferred shareholders would get $35,000, right? 5,000 shares times 7. But because they own what's called cumulative stock, they're going to receive 3 years here because it said they're in arrears for 2 years. Dividends in arrears is a title, is a term telling you that past dividends have not been paid to shareholders of the preferred stock. You bet has 10,000 shares of 8%, $100 par, no dividends were declared. If you bet wants to pay $375,000, how much would the common holders get? Well, we'd have to figure that out. 10,000 shares times 8%, that's $8. That's $8 per share. That's 80,000, and they want to give out 375. I'm guessing the 135. 10,000 shares, 8%. No dividends were declared. If you bet wants to pay 375, common stockholders will receive 135. Does that look right to you? It doesn't look right to me. Let me take a peek at this. 10,000 shares, cumulative. Oh, no dividend. There is no dividends were paid in 20 or 21. I missed that part, Derek. So yeah, that's how the arithmetic would come out. 135,000. Are you good on that, Derek? Did I confuse you more than anything?
No, I think I get it. You just do the 10,000 times 0.8, and then it's because the 2 years before you subtract that from the 375 minus the 2 years before, right?
That's exactly right. That's right. That's what the dividends arrears are all about. Good, you got it. Preferred stock dividends. Here, preferred stock dividends. As 2,000 shares of 6% stock, the company declared a 60,000 cash dividend. Compute the dividend paid to the preferred and the common, okay? So we have 2,000 shares at 6% of 100, so that'd be what, $12,000? And they had 60 available. So now the common people get the 48. They get the difference. Simple as that. Simple as that. The preferred people, 2,000 shares times 6. That takes care of the preferred. The common stockholders pick up the rest. One digression here, Derek and everybody. Common stock has 2 ways of making money. Common stock, you can collect a dividend, and that's nice. But more importantly, common stock has the possibility of going up and up in price over a period of time, which is what you're hoping it will do. Preferred stocks are like a bond. in that they just react a little bit to interest rates. If a company found a cure for baldness, the common stock would go through the roof, but the preferred stock isn't going anywhere. That stock is hardly going to change at all, because with the preferred stock, you're limited simply to that dividend. Okay, it's the common stock that has the big upside, and young people like in college would probably ignore preferred stocks right now. That's an investment for an old guy like me, maybe. And now the stock is non-cumulative. That's the same slide, it looks like. Okay, here, 2,000 shares. That's 2,000 shares. That's $12,000 a year. The preferred stockholders are going to get paid for 3 years, 36,000, and the common stock people get the difference of 24. Now we're talking about what are called stock dividends. We've been looking at cash dividends. Stock dividends satisfy stockholders' dividend expectation without spending any money. It can increase the marketability of the corporation's stock, and it emphasizes a portion of stockholders' equity has been permanently reinvested in the business. Here's what a stock dividend does, Derek. You own 100 shares of my company stock, and the stock is selling for $2 a share. So you have $200 worth of my company stock. I make an announcement. Hey, Derek, I'm giving you a 100% stock dividend. You now own $200, 200 shares of my stock, but the price of the stock has been cut in half to $1. In other words, you owned 100 times 2 at the beginning. Now you own 200 times 1, okay? And you end up exactly in the same spot you were at the beginning. But the reason that companies issue these stock dividends is somewhat psychological. If the stock price is going up and up and up, fewer and fewer people feel comfortable going in and buying it, especially the small investor. You know, somebody like you and I, Derek, we tend to think in terms of lots of 100 shares. Well, Apple went all the way up. Apple and Amazon, I forget which one, it was Apple. Apple went from like $5 a share when they were almost out of business about 15 years ago before Steve Jobs returned. And the stock went from $5 to $1,700 a share. At $1,700 a share, they decided to split the stock, decided to give out a stock dividend. And what that did, it greatly reduced the market price of the stock while giving out extra shares to the people who already own the stock. So I happen to love it when my stocks give me a stock dividend, because that often means that the price is going to rise because the price has come down to an affordable level. Now, of course, the public can go out and buy a half a share of a stock. You can do that. But psychologically, you're always talking in terms of lot numbers of like 100. There's a difference between a small stock dividend and a large stock dividend. We'll go over this a little bit. If it's less than 20 to 25%, you record it at the fair market value of the stock based on assumption that a small stock dividend will have little effect on the market price. The large stock dividend is different. You're going to record it at the par value. The difference is this: the small dividend, and we'll see it in a minute here, you're going to debit retained earnings and you're going to credit common stock. On the large dividend, you're going to debit retained earnings and you're going to credit the par value of the stock and the paid in capital on top of that. So let's take a look at it here. This is a good grid here. They're showing you before the dividend, the total stockholders' equity was $800, right? $800. We issued a dividend of $75,000. So our retained earnings went down. You always debit retained earnings if it's a dividend. You always debit retained earnings no matter what type of dividend it was. Here, we debited retained earnings to reduce it, and we credited common stock at par and paid in capital in excess of par. So that made that a large dividend, okay? Small dividend, you don't have to worry about the paid in capital. It would be 75 and 75 under common stock. A stock split is nice. A stock split is the same effect on you, Derek. You have those 100 shares in my company at $2 a share. My company announces a 100% stock split. It means that you now have 200 shares times $1. It works out the same way as the stock dividend. If you got this notice in the mail, you would have no idea of knowing if you just received a stock split or a stock dividend, unless you read the letter a little more carefully. The truth of the matter is you don't care because it comes out the same way. A stock split does not require an accounting transaction. A stock split does not require an accounting transaction because all they're doing, all the board of directors is doing is changing the par value of the stock to match up. So a stock split, there is no financial journal entry to be recorded. And it's done the same way as a stock dividend. Additional shares go to shareholders based on their percentage ownership. The par value goes down. The shares outstanding increases. The market value comes down. No journal entry required. No effect on anything in the equity. Wow, look at this, a 4-for-1 stock split. We love these. Apple's, like I said, Apple had a 7-to-1 stock split. So here we go. You owned 40 shares. Now you own 40 times 4 shares. Now you own 400 shares, okay? 500 shares, actually. You own these 4 here plus these 40 over here. Stock split. And they're showing you the impact, again, on the equity statement. On a stock split, Derek, nothing changed, huh? Nothing changed all the way down to equity. Nothing changed. The only thing that changed was they changed the par value of the stock from 10 to 5. And that is not an accounting transaction. That's a legal documentation. Difference between a stock split and a stock dividend is a stock split has a stock split. Well, let's look at this together. I've never seen them line up like this before. Total paid in capital. Stock dividend paid in capital would increase. It would increase because you're debiting retained earnings and you're crediting common stock. So that would go up. Stock split, no change. Retained earnings goes down for the same reason. Par value is gonna change. It's gonna go up. The stock split, no change. Par value, decrease on stock split. You might look at this grid just a little bit. This would probably be a source of a couple of multiple choice questions on the test, I would think. But keep in mind, stock dividend, you have journal entry, you debit retained earnings, you credit common stock. Stock split, no journal entry at all. 0. Which of these statements about stock dividends is true? B is true. A stock dividend has no effect on total owner's equity, okay? Due to 5 years of record earnings, the market up price of $2 has gone from, tripled from 15 to 45. Paid in capital stayed the same. Retained earnings went way up. President Joan Elbert is considering whether or not she wants to give out a stock dividend 2-for-1. Show the before and after effects. Well, this is more of a homework thing, but let's see what they show us, okay? She's thinking about a stock dividend or a stock split. So here's what we have here. This is our equity section sitting right here. After a stock dividend, the retained earnings is going to go down and the paid in capital should go up if there's a God in heaven, right? Unfortunately, they're not showing it to us, but that's what would happen, Derek. We issue a stock dividend. We know we debit retained earnings, so that 10,000 is going to come down and the paid in capital is going to go up. The outstanding shares are going to go up. The par value is going to come down. The only thing the stock split does is change the par value to match things up. Okay. How stockholders' equity is reported and analyzed. Is net income net income that a company retains? It makes no sense, that sentence. Is net income that a company retains in the business. Net income increases retained earnings and a net loss reduces retained earnings. I think we know that. Retained earnings is part of stockholders' equity. We know that. And a debit balance in retained earnings, well, we're going to call that a deficit. That's not a word we used yet. But yeah, if you have a debit balance in retained earnings, that means that the company has lost money ever since over its existence. And technically, you're out of business. Technically. Of course, you have a chance to bounce back with a good year. Presentation of accumulated deficit. Here, they're showing you the paid in capital, and the deficit is minus 921. So that really hurts. That means this company can't pay any dividends, and it means that they have lost money over the history of the company, assuming no dividends were handed out, okay? Assuming no dividends went out. So let's see what we got here. Retained earnings restrictions. Again, they're just repeating that you can't issue stock if you don't have enough retained earnings. You can't spend what you don't have, okay? And there could be contractual restrictions, voluntary restrictions. Balance sheet in the presentation. Well, we just looked through this. Paid in capital, retained earnings, accumulated other. Let's take a look. A picture is worth 1,000 words, huh? Wow, look at the size of this equity statement, huh? But let's divide and conquer. You're going to start off with with preferred stock. 9% preferred, 10,000 shares authorized, 6,000 issued. Okay, 6,000 times 100. That is your 600,000 there. And then you have the common stock. You have 400,000 shares issued times 5. That's your 2 million. Now we got to figure out the paid in capital, Derek. How much was paid in excess of the par value? Well, you have 400,000 shares here. They were issued for $5. 9%, 6,000 shares. I don't see where they give us the information for that. Additional paid in capital in excess of par value, 30,000. Paid in capital in excess. Let's not worry about the numbers. I'm more worried about the presentation. The additional paid in capital goes below the common stock. Typically, Derek, the way I've seen this before and the way it is, as far as I know, in the real world, you're going to show the common stock right here, the 2 million, and you're going to show the paid in capital of 1,050 right under it. Here, they're separating them into two different categories. Total paid in capital. And now they have some treasury stock that they bought back, which reduces your capital and gets you down to 4,730,000. They had accumulated income of 110,000 minus the treasury stock gives you total stockholders' equity, 4,760,000. Jennifer Corp has issued 300,000 shares at $3. It's authorized to issue 600. Paid in capital in excess of par value is 380. They've required 15,000. Here, well, obviously, we're not going to do this right now, Derek, but looking back at that template right there, you want to be able to put these parameters into it, okay? And it looks like they this time they did it for us, huh? They issued 300,000 shares of $3 common stock. 300,000 shares times 3. There's our 900. The preferred stock, 4,000, 8% preferred. It gave out 10,000 shares. They issued 4,000. $4,000 times $100 par value, 400,000. So we know where these numbers are coming from. The paid-in capital in excess of par. The paid-in capital excess of par on the common stock is 380. And they required 15,000 shares into treasury stock. So there's your 380. There's your $15,000 shares of treasury stock. So being very familiar with this template, I think would be quite helpful on the test, Derek. I could see a lot of multiple choices coming in and out of this thing. Let's look at a new metric now. Cash dividends divided by net income. Cash dividends divided by net income. Well, this company, whoever it is, Nike, oh, famous Nike. They had income of $1,033,000. They divide that out. They had dividends rather of $1,033,000. You divide it out by 4,240 in income, and that gives you what's called the dividend payout ratio. So this is telling the shareholder that there's a pretty good chance that you could get a dividend. Nike has plenty of money if they want to declare dividends. Here's a very normal metric: return on stockholders' equity, return on common stockholders' equity. Here, we're going to take the net income, whatever the net income is, we're going to subtract the preferred dividends. And the reason we subtract the preferred dividends is because no common stock dividends can be paid until the preferred guys are paid. So net income minus preferred divided by the average common stock equity, which is just the average between the beginning and the ending of the year. And you come out with 34.4% and 30.1% for Nike, I guess. Return on equity. So that's a pretty darn good return, I would think, huh? 34%. If Phil Knight had taken his money and put it in a bank, not willing to take a risk of running a business, he would be lucky to get 1%. Debt versus equity. They have various advantages and disadvantages. The prior chapter was debt. Bond financing. We're borrowing money. Well, if we borrow money, we're not giving away part of ownership of the company to anybody. Bondholders have no voting rights, so current owners retain full control. If somebody bought $1 million of your bonds, they have no leverage over you. They can't go to the annual shareholder meeting and say, well, if you don't start doing things differently, I'm going to sell my bonds. We would laugh at those people. Go ahead and sell them. It has nothing to do with this company. But if it was $1 million worth of stock they threatened to dump, then we'd have to perhaps negotiate with them. And you get tax savings in that the interest on the bonds is tax deductible. And although bond interest expense reduces net income, return on equity often is higher under bond financing because no additional shares were issued. I would imagine the next page. What's the matter with this thing? Come on. Return on common stock. Return on assets, leverage, debt to asset ratio. Whoa, look at that. Return on assets. Return on common stockholders ratio. Again, they're asking us to do something. Microsystems has 100,000 shares outstanding, $25, no debt. it's thinking of raising 5 million. They can issue shares to the public at $200,000, 25% par, and hopefully it sells at a price where they'll get their 5 million, or they can borrow the money with a $5 million bond. And income before the interest and taxes are going to be $1.5 million. Income taxes are 30%. The alternative effects on the return on common equity are as follows. Look at the stock issue. The income, $1.5 million. We issue to the public. There's no interest expense. We're giving away stock to the public. We're giving away part ownership. The income tax expense is going to be $450,000, okay, on a certain amount of income. There's the income right there, $1,050,000. That's net income after taxes. Over here on Plan B, the income before interest and taxes are the same, but remember, with a bond we have to pay interest, so that's where that 600,000 comes from. That gives us income before taxes of 900, and thus 3 times 9, 30% times 900,000 is 270,000. Our net income is a lot lower under bonds, which means we pay a lot less in taxes. Okay, so you can see they each have good benefits, good arguments for one over the other. Common stock equity, 7,500,000, because we gave out all kinds of new shares. Here it remained at 2,500,000. Remember, we gave out 5 million, they said on the prior slide. Yeah, they were looking for $5 million. So the returns on the corporate, on common equity can be quite different depending on what you chose to do. Okay. Sienna purchased 2,000 shares of treasury stock. Compute the return on common shareholders' equity for each year. Well, let's take a look here. They purchased 2,000 shares of treasury stock. Do they say how much they paid for the treasury stock adjusted for purchase? Let's see here. Net income was 110 both years. Preferred dividends didn't change. The dividends went down because they sold $400,000, it looks like, of treasury. They bought 400,000 worth of treasury, and then that we adjust the common stock equity at the beginning of the year, and we come up with our figures. And we're getting to the end here. Entries for stock dividends. Midland declares a 10% stock dividend. Record the entry. You debit retained earnings. When it says stock dividends, that also is the same thing as retained earnings. You debit retained earnings. You credit common stock at par, and the difference is paid in value, in excess of par, paid in capital in excess of par. Record the journal entry for the issuance of the dividend shares. We debit retained earnings, we credit common stock. And that takes us to the end. We're not going into IFRS at all. Wow, that was a lot in that chapter, huh, Derek?
Yep.
Yeah, I think you get a pretty good feel for it, huh? I don't think this is as tough as the bond chapter.
Yeah, it seems, I mean, it's kind of going over it. It feels like the class kind of started on just like a balance sheet, like assets, liabilities, and stockholders' equity. And now it's kind of working into like detail about the 3 categories.
Exactly, especially the equity section. Yeah. Okay. Well, if you have any more questions, I'll call a stop to the meeting. Okay.
Sounds good. See you later.
All right, Derek. Thanks for popping in. We'll see you in there. We'll see you in a couple days. Bye-bye.